Okay, so let's get started. What I want to do today is just go through in a very high-level sense some of the major changes over the last number of months, especially starting in July with the release of Portfolio Builder. And what I've found to be most effective in doing these sort of overview webinars is just to use the VisionWorks menu to kind of go through and hit some of the high points. So what I'm going to do today is I'm going to try and remember to mute while I'm sort of explaining things. And when I've explained something, then I'll unmute and we'll throw things open for questions. So we'll sort of do that back and forth. I'm going to start by muting now.
The conference is now in silent mode.
So the first thing that I want to do is cover Portfolio Builder. So the idea behind Portfolio Builder is that portfolios are portfolios, whether they're in open money, non-registered portfolios, TFSAs, RSPs, whether you're doing the Smith plan, the Jones plan, doesn't really matter. So the concept is building portfolios in one place and then accessing them over and over again very easily in all the different files that you create. Now you'll notice that there's an introduction video which is 4 minutes long, and what it does is it's a quick survey of the 4 approaches you can take to portfolios. So the idea is play the introduction video, identify the approach that you take, and then play the appropriate video to learn how to model portfolios using Portfolio Builder. So the first thing that I'm going to do is I'm actually going to open up Portfolio Builder and we'll have a quick look at it. And what we're going to do is we'll just do a high-level review of the 4 approaches. So a basic portfolio is one that you construct without any regard to the actual content of the portfolio, the specific holdings. All you want to do is understand how hard does somebody's money need to work for them. You'll notice that we've actually built in the 3 recently released FPSC, what I'll call model portfolios. But for you to create a portfolio, all you need to do is click the Add button, give it a name, and then assign the different returns that you want to use. Now, it goes without saying that if you're dealing with registered money, all you need to do is have a single return, 5% for instance. But because some clients may certainly have open or non-registered money, then putting in some mix of interest, dividends, and capital gains is necessary because of taxation. So you'll find this approach is extremely easy to work with. The second approach, SMAs, separately managed accounts, what you're able to do is create any number of portfolio managers. We've built in the 4-strong portfolios. 4-strong was previously HAN. And then for each portfolio manager, you can add any number of SMAs that they have, separately managed accounts. And to do that, all you need to do is click the Add button, give that SMA a name, assign the returns, the overall returns that are being projected for that type of portfolio, and then what you're able to do is add in the different general asset classes and the percentage weighting. So you'd really be mirroring some portfolio that is offered by that portfolio manager. If we go to asset allocation, this is our standard model that we've had for a very long time. There are the 10 basic portfolios, all of which you can edit as far as their weightings are concerned. There are also now 10 segregated fund portfolios. And as before, you can go in and you can edit any of the return assumptions. You'll notice that there's an additional feature now where you can assign a standard deviation. And the standard deviation numbers that come up are ones that we get from a company called Fund Data. The fourth approach to portfolios is one where you're actually going to create specific portfolios with specific holdings. And there are really two approaches to doing this. Again, you can create any number of these. So I'm going to call this one my balance. And I'm also going to say favorites. And I'll show you the difference between the two. So once I name a portfolio, then I would open up the asset class, and I'd be able to then add any different asset classes, mutual funds, ETFs, GICs, and I can mix them up. I can have a number of these in a single portfolio. Once I've selected the asset class, I click the Add button. Sorry, let me just get rid of this. And what I'm able to do is I'm able to go in now and start adding mutual funds to this list. And the way you do it is you just select a category, click the Add button, and then simply type in the mutual fund code. So as an example, AGF 203. And when I hit the Enter key, that's now populated with all the historical returns for that AGF fund. If I go down to balance, for instance, click Add, I can now put in some other funds. I'm going to use a McKinsey fund. Again, click Add, and I'm going to add one more here, an EdgePoint fund. Now, the data that I'm loading in comes from Fund Data, and the database that they provide for us and that's built into the software has now 53,000 listings, and that includes mutual funds, segregated funds, and ETFs. The other thing that you can do to load data is you can actually do an import from Morningstar's Advisor Workstation. If we go back to the website, you'll see there's a PDF file. It's 4 pages with screenshots and step-by-step instructions that tell you exactly how to set up an export file in Morningstar that you would then import into Portfolio Builder. Now, there's a difference between the two. When we do this import from the Fund Data file, one thing that's not populated are the different sectors for that fund. You could go in if you wanted to, look up the weightings of the sectors in Morningstar, which you could do for free, and then you could manually enter those. Bit time consuming, but nevertheless possible. When you do an import from Morningstar, those sector weightings are already populated. The other thing that I want to point out, if we have a look at this EdgePoint fund, the interest, dividend, and capital gains returns, of course, the fund being a trust, a mutual fund trust, any earned returns have to be paid out every year. So that's the interest, dividend, and capital gains amount, or amounts. And then the net asset value is the increase in the value of the fund as a result of the unrealized gains in the underlying holdings. And you'll notice here that this is 15%. So my suspicion would be that this fund came out sometime after the market crash in 2009, and that it's enjoyed relatively good historical returns as a result. You can go into any of these fields if you wish and edit them to make them something that you feel is a little more realistic on a go-forward basis. So populating either the mutual fund subclasses, ETFs, it's just a matter of typing in the code, or doing an import from Morningstar's Advisor Workstation. Now, when I started, I mentioned I could set up my balanced portfolio. So I want you to think of that as a model portfolio. I might have a conservative portfolio, a growth portfolio, an aggressive growth portfolio. And I also mentioned that you could work just on the basis of favorites. So favorites would mean that you're just going to add a number of mutual funds, let's say, to the list. Arbitrarily, I'll say your 20 favorite funds. And then in VisionWorks, you could bring them in on some mix and match basis, literally just choosing different funds on a client-by-client basis. The other thing you can do, the My Balanced portfolio, is set up model portfolios. So a balanced portfolio, a growth portfolio. And to do that, all you're going to do is drag and drop the funds that you want to include in your balanced portfolio onto the list, and then indicate what percent weighting each fund has within that model portfolio. So there are two approaches: model portfolios, or just creating a list of favorites that you'll use on a mix and match basis in VisionWorks. So what I want to do now is I actually want to switch and show you how all of this integrates into VisionWorks. So I'm going to open up the VisionWorks file, and we'll actually bring some portfolios in. So first of all, if I go to Bill's non-registered portfolio and current holdings, there are a few approaches here. One, if I go to Detailed and select Current Holdings and then click Portfolio Holdings, I can actually do an import from a back office system, OneBoss, Univeris, Wind Fund. And in order to do this, the first thing I have to do is set up the export file for Bill, let's say in Univeris. So if I go to Univeris, I'm going to let you in on a little secret in a moment. Let me just see if we've got it here. There's this Bill Smith export file. And when I go to open it, you'll notice if I open the list that the export file has two accounts for Bill, an open portfolio and an RRSP. So I need to select open because I'm bringing this into the open portfolio. I would have to do a separate import for his RSP. When I click the yes button, everything is imported, the different funds in the portfolio, their values. Now you'll notice that the ACBs are not populated. We approached Univeris about adding the ACBs to the export file, but they wanted to charge a very large fee, and also what they wanted to do was they wanted to charge each of our clients a fairly hefty fee, so we opted not to take that approach. So I've got the choice of doing an import into current holdings, the existing portfolio. I could, on the other hand, go to that balanced portfolio that we created. Let me just find it here. Oh, I have to apologize. I created that balanced portfolio on my desktop, and I'm now using actually something that's different. So I'm going to just select the demo portfolio, and then it would have whatever holdings are in it. Let's see, that one doesn't have anything. Let's see if we have one here in growth. So there we are. We have a growth portfolio now, and you'll notice it actually has different funds in it. The other thing I can do is I can select current holdings, and then I can click the portfolio holdings button, and I can do an add where I go to my list of favorite mutual funds. Again, I'm working actually in a different environment, so I'm going to just add one here, MSC 3774. And have my list and then just add things to Bill Smith's open portfolio on that mix and match basis. So again, I can either select an existing portfolio I created, or I can just add things in on a mix and match basis. The one other thing that you're able to do, and this is important, is after you've populated the portfolio with whatever Bill has now, then when you go down to solutions, what you're able to do is you're able to look at changing portfolio allocations over time. So the current portfolio may not be earning a high enough return for them to accomplish what they want in life. You could then go to the Allocation tab and select an alternative portfolio. I'll actually use the 4-strong portfolio. So you just select it, and then you could apply it. You can also go out in time, and you can see this here, where you can change portfolio allocations over time. So maybe Bill wants to be more income-oriented and so on in his retirement years. So the idea is you can populate portfolios, what are your current holdings, and then you can go in and either change those current holdings because money needs to work harder, change them later in life because the job description for the portfolio is going to change. So let me just unmute and we'll throw things open for questions.
The conference is now in talk mode.
So what questions have come up? Anybody with any questions on Portfolio Builder and how it integrates into VisionWorks? Either I was very clear or everybody's totally confused. Which is it? Should we move on then?
Yeah. Hold on. Actually, I had a question.
Yes.
Hello, it's Paulo Fidenza here. How are you?
Fine, thanks. How about you?
Good. So for the portfolio builder, in respects to creating an export file, how would we go about doing that? Like, what were those back office solutions that you were?
We link currently to 3 back office systems: Univeris, WinFund, and OneBoss. OneBoss is Sterling Mutual's back office system.
Okay. So, all right. So basically, we would have to have software associated with one of those solutions in order to create the import file, or is there?
To do the import from a back office system, correct?
Okay.
What, do you know offhand what your back office system is?
Sorry?
Do you know what yours is?
No, well, see, the thing is, I'm just an independent consultant, so I don't really have a back office solution. I guess what I'm asking is if I had to get this, if I had to get an import file, let's say from my financial advisor, how would I go about doing it? Would it be more likely like through a Morningstar file or?
No, if your advisor has, OneBoss, Univeris, or WinFund as their back office system, they would just create that export file.
Okay.
It's a comma delimited text file, attach it to an email and send it to you, and then you just do the import.
Okay, I see. All right. And then what about importing a file from Morningstar? Would that too come from my investment advisor?
Yes, we're not set up to necessarily import specific portfolios that are modeled in Morningstar. It's more importing different mutual funds, which are kind of like the preferred funds that an advisor works with. You know, like the 20 funds or something like that.
Oh, okay. All right. Okay, very well. Thank you.
Okay. So let's move on. One of the things that we want to cover today are these retirement assessment plans, just to make sure that you're aware of how they work. So I want to go back to our VisionWorks menu, and we'll go down to the retirement assessment videos. There's a graphic, oh, sorry, we logged out. There's a graphic that we have on this page that we actually lifted the data from an article by George Hartman in Investment Executive a year ago, August. Hartman is a regular monthly columnist. And the way his column works is that he receives a question from an advisor, and then the column is structured as a back and forth exchange. Hartman's comment, advisor's comment, Hartman's comment, and so on. So a question had come in, and the first question that Hartman asked was, have you segmented your book? And the advisor said yes, that 20% of his clients were A and B clients, 80% were C's and D's. Hartman asked if he'd assigned revenues to the different segments, which the advisor hadn't. So the article continued after he had, and what he found was that the 20% of his A's and B's were generating 70% of the revenues, and the 80% of the C's and D's were generating 30% of the revenues. So pretty much the 80-20 rule flipped over, which we, I think, are all fairly familiar with. So I think that this, the key to all of this is understanding what I call the frequency versus productivity trap. And essentially what it is that if you're going to do a plan for every client, your experience is that 8 out of 10 plans are for C and D clients who actually don't generate that much revenue. So these plans have to be done in good quality, but extremely efficiently. And I'm going to suggest that the type of plans you provide for your C and D clients may not cut it as far as satisfying your A and B clients, that they're expecting something a little more thorough, a little more in-depth from you. So one of the things that we did starting a year and a half ago, and we continuously work on this, we continuously are refining it, is that we scaled back VisionWorks in order to be able to create what we call retirement assessment plans. Now, as we all know, the concept financial planning or the term financial plan is very broad-based. And so, you know, it ranges anything from some sort of calculator on a mutual fund website as a financial plan through to very detailed cash flow plans. So I'll make this distinction that a plan which is will I be okay in retirement that focuses just on retirement years, that's what we call a retirement assessment. Often it's going to be called a financial plan. And scaling back VisionWorks to be able to do these, there was no loss of the more sophisticated number crunching that we do under the hood. So tax returns are done properly every year, whereas software that's designed to answer the question, will I be okay in retirement, often, for instance, just uses average tax rates. So in scaling things back, we were able to maintain the quality of the number crunching. So the thing that I also want you to notice is that there are 2 flavors of retirement assessment plans, a plain retirement assessment and also one that we call a retirement and estate assessment plan. Retirement assessment is very mom and pop, very straightforward, will we be okay in retirement? The problem in today's world, however, is that as a society, we're experiencing about a 40% divorce rate. So we know that there are a great many clients who are in second marriages, have blended families. Assets will be going to children from a previous marriage, either because those assets are being transferred to children or because of tax implications. The importance of including the terms of wills in a plan can't be underestimated. In that case of second marriage blended family, if we're not including the terms of wills in the financial forecast, then we can definitely be misrepresenting the financial circumstances of the surviving partner. So the retirement and estate assessment plan incorporates the terms of wills, the cornerstone of proper estate planning, and it also allows you to do life, DI, CI, and long-term care insurance needs analysis. So generally speaking, our recommendation is if you're going to do a retirement assessment, will I be okay in retirement, that you actually do a retirement and estate assessment plan. The other reason for it is that you may be dealing with a higher net worth client, and I would suggest answering the question, will I be okay in retirement, is a bit of a ho-hum for them. They are high net worth clients. They're going to be okay. So I'm not sure that there's any kind of really profound value add if that's all you're showing them. They pretty much already know that. On the other hand, if you're doing a plan for a high net worth client, it may well be that their primary issue is an estate gap. They have lots of assets, but the question is, will the estate have sufficient liquidity to pay terminal taxes, estate administration taxes, and so on? So by doing a retirement and estate assessment plan, you're able to uncover any estate gap, and in doing so, I think bring a real value add to the high net worth client. So what I want to do is very quickly show you how these work. And before we jump into them, what I'm going to do is I'm just going to go to the questionnaires page, because one of the things that we came out with again a year and a half ago, but we've been evolving, are these fillable PDF questionnaires. And you can see that there's a financial planning flavor, but you can also see there's a retirement assessment version, a retirement and estate assessment version. Oh, we've got some background noise. I'm going to go back on mute. I forgot to do that. Hang on, please.
The conference is now in silent mode.
So you can see there's the retirement assessment, retirement and estate assessment fillable PDF questionnaire. And then for each of them, there's a pre-retirement and post-retirement version. So the pre-retirement version obviously asks the question, when do you want to retire? The post-retirement version doesn't ask that question. It wouldn't make any sense to somebody who's already retired. So what I thought we'd do is have a quick look at these, and then we'll show you how they integrate. And the reason that I want to speak about these questionnaires when we talk about retirement and estate assessment plans is that they're very much sort of the key to why you can produce retirement assessment plans for C&D clients in particular extremely efficiently. So first of all, I'm just going to bring up the pre-retirement version. You'll notice these buttons, freeze form, remove logos. One of the things you can do is add up to 2 logos to the questionnaire. You can also go in and add any introductory or disclaimer text you want. And when you've done that, then you click the freeze form button, and these buttons would disappear so clients can't see them, and all that text and so on is locked in. If you go down to the bottom of this, you'll also notice there's a submit button and then another button that says load from FDF, and we'll come back and talk about that later. So this is the basic form. One of the things that we can do for you once you've added your logo and disclaimer or explanatory text at the beginning is we can also change these colors for you. So we can customize the colors, we can customize the positioning of the logo at the beginning. Maybe you just have one logo, that sort of thing. So you'll get a very customized look. And just to give you an idea, I have a little demo questionnaire. We've made up this company, Coastal Wealth Management. You can see all the colors are different. So it's that customized look. So all you're going to do is take this questionnaire, attach it to an email, and send it out to a client. The client's going to open it up and then just start to complete the different fields. One of the things you can do is you can pre-complete some of these fields with known information, client's name, date of birth, province of residence, anything like that that's going to reduce the amount of time and effort the client has to put into completing the questionnaire. If you do pre-complete them, you don't want to save the questionnaire as your default questionnaire. You want to make sure that you save it in the client's name before you attach it to an email and send it out to them. So what I wanted to do is just scroll down a little bit and review some of the content. You'll see they're very easy. What are your desired general expenses during retirement? Our recommendation is that home and vehicle expenses be itemized separately, and we'll look at this in a minute, and I'll explain why we make that suggestion. Client puts in their salary or their self-employed income, desired retirement age. You can see all of this is very straightforward. When it comes down to homes, here's where we talk about separating out some of the costs of running a home. And then you'll see down here, separately itemizing the costs of running vehicles. And the reason that we suggest this in the case of homes is that VisionWorks attaches the cost of homes directly to the home. So it's not uncommon in today's world for people later in retirement to think in terms of downsizing their home. So if you do put in a sale date for a home, then the expenses related to the home automatically end. If the client then says, oh, gee, instead of 65, maybe we'll downsize when we're 70, you just change the sale date, and then the expenses associated with the home would automatically adjust. So from a planning point of view, associating home expenses directly with the home actually makes it much easier than going and goofing with, those sort of general expenses. The reason for vehicles is very simple. If the projection is going out to, let's say, 95, it's very likely that people may not drive after a certain age, whatever it might be, 80, 85. So if you're dropping off $5,000 a year of expenses, let's say for 10 years, that's $50,000, and because it's late in life and it's inflated, it's actually a great deal of money that puts a substantial drain on portfolios. So again, this is something that just automatically allows you to drop off those expenses. If we scroll down to the next page, you can see clients put in the value of their existing portfolios, what they contribute to TFSAs, RSPs every year, and so on. Very straightforward. And then down here, they would simply click the submit button. When they do, what happens is they can attach a password to the file because it's flying around on the internet, and then we may not have we don't have a webmail set up. I'm going to explain in a minute something that I'm showing you today. So it attaches what's called an FDF file. It's a PDF data file to an email, and then they just address the email and automatically send it out to you. what happens from your end is that once that comes in, you save that FDF file wherever you wish on your in the client record, for example, and then you simply run VisionWorks. Let me get out of this, sorry. You simply run VisionWorks and then click the Add button. Say I'm importing from a questionnaire. It's a retirement assessment. You give the file a name. I'm going to call it Smith FA for, RA for retirement assessment. And then all you do is you go and locate that FDF file that they sent you, click the Open button, enter the password that they use to encrypt their data, and then you just open up the file, and all the different fields are properly populated. So we go to the About page, we can see Bill and Sue are brought in. As far as life expectancy, we recently defaulted to the FPSC suggested life expectancies for males and females. But all the entries are in. We can see the value of their home was imported, what they paid for property taxes that they entered on the questionnaire is imported. If we go to Bill's career income as an example, you'll see that his salary is imported. The end date, 2025, is when he turns 65, which is his desired retirement age that he entered, and so on. So everything is just automatically set up. Essentially, to this point, you have done absolutely nothing. All you've done is maybe some pre-completion of the questionnaire, known data, attached it to an email, sent it out to the client. The client's done all the work, sent the file back, you've saved it, and all you've done is run VisionWorks, click the Add button, and imported everything. Virtually a few minutes of your time. So I'm going to unmute now and then, throw things open to questions up to this point.
The conference is now in talk mode.
So, any questions that have come up?
Michael, it's Jeremy. I'm just going to make a quick comment as well in regards to the tailoring of the questionnaires. As Michael said, yes, we can certainly change colors, adjust where we put images. One other thing that I find very useful that we can adjust, in the coding of the questionnaire is when we do hit the submit button, or when the client hits the submit button, we can add your specific email address so they don't have to dig around for it. One less headache. So they just hit submit. It'll open up an email in whichever email client they use, and then it will send it directly to you. So in order to do any of that, all you have to do is just let us know, and we'll certainly have them customized for you.
Any other questions?
Blair Corkum here. Can you hear me?
Yes.
I don't know if my technology works. So what do you think is quickest, actually, when we're meeting directly with the client instead of having the questionnaire done in advance? Is it easy to sit with them and fill out the questionnaire and do the import, or to work through the entries?
Perfect. This is a great question, Blair. Thanks. There's essentially two answers to the question. One is, if all you're intending to do is a retirement and estate assessment, then I would suggest working through the questionnaire. Whether you write answers down on a paper-based questionnaire and then later populate the electronic questionnaire, or whether you populate it live with people, if your intention is only to do the retirement assessment type plans, then I would definitely use the questionnaire, because as soon as you do that import, all the right fields are correctly populated. Now, there's a big difference, though, between doing a retirement assessment plan and doing a more robust financial or life plan. And in those cases, what we want to do is we want to explore with people the things that they're thinking they would like to have and do in life. So that's a much richer conversation. It's a much more detailed plan. So working with them and going through all these different areas, talking about vacations, talking about the vehicles they want to drive, I would say that's a very different thing. So if we come back to that A and B client conversation, I would suggest working with them and having that richer conversation is very appropriate for A's and B's, whereas the questionnaires and the retirement assessment plans are more appropriate for the C's and D's. We need to generate something that's good quality, but we can't take a lot of time. Does that answer your question, Blair?
Great, thank you.
Okay. So one of the things that I'm just...
Michael,
yeah, go ahead.
just make one quick comment
Yeah.
here. Kind of to Blair's point, and something we've started to do, and I've experienced this with some advisors, we're actually starting to lock down the questionnaires for printing, and it seems a bit heavy-handed, but the reason is, and I've seen this, that an advisor will send the questionnaire to a client electronically, and a lot of times the client may just print it off and fill it in with a pencil. Unfortunately, that saves nobody any time. All of a sudden now you're trying to decipher what they wrote. It's now going to be a bit of a back and forth to give them a call, try and straighten things out. So we're locking them down so that a client is more forced to complete it electronically, send it back to you in the way it was designed to really save you that time, because you can understand if they're faxing you back a scribbled on questionnaire, it's just going to make your job that much harder. So.
Yeah. And I'll actually add one more point, Blair. These retirement assessment plans are extremely flexible. They will flex up to a full meal deal. So if the client, before you meet with them, pre-completes the questionnaire, you can populate everything with all of the basics. But that doesn't preclude you from sitting down with them, bringing up the software, and then reviewing some of these different things to maybe enrich the conversation that you're having. So just as an example, we've talked about the general expenses we want in retirement, but we might have a conversation with people about charitable giving. That might be very important to them. So you could still add that in, and the retirement assessment plans will still flex right up to, full cash flow-based plans. So the idea of today is to go through some of these basics and talk about this flexibility. It's really, once you understand how all this works, then you can tailor it not only to your preferred way of working with people, but also the client's preferences. So you may well have some clients who want to just take a high-level approach, but you may have other clients who really want to get into a lot more detail, a lot deeper exploration. So if that's the client's wish, then you can, adjust the approach you take to be able to accommodate that. So what I want to do now is show you how these retirement assessment plans come together. So first of all, what I want you to notice is that when we start off, we start by creating, this is the import file, what we call an initial assessment. And the idea of an initial assessment is merely, given what you've got, TFSAs, RSPs, et cetera, given what income you said you wanted in retirement, are you on track to achieving those retirement objectives? So the initial solution that is created is called an initial assessment, and what you're able to do is print a quick 2-page report for immediate feedback. So the idea is the client sent you this questionnaire. Their question is, will I be okay? And instead of waiting till you get to, building a plan and meeting with them and all the rest of it, quite literally right away, you can send them something that gives them some idea if they're on course or not. And this is even something that an assistant can do. So if we have a look at this little 2-pager, what it does is it's just restates their initial goals, the total income they wanted, their desired retirement ages. And then if we scroll down, this shows a projection for what we call income assets. So hopefully you're all familiar with this concept. Basically, what it says is, in retirement, you can't eat your house. So in VisionWorks, the output is net worth, assets minus liabilities. Then there's output for what we call income assets. So income-producing assets, open portfolios, TFSAs, RSPs, rental properties, things like that. Anything that we will draw on in retirement to pay those retirement expenses. So it's a relatively simple concept. It's explained here. You can edit this text if you don't like that explanation. And whatever's imported, the text, shortfall, surplus, is all context sensitive. So if the graph shows a shortfall, the text will say a shortfall. If the graph shows a surplus, the text will say a surplus. And then if we go to the next page, again, it's context sensitive. What this does is it suggests options for people. You could think in terms of downsizing your home. You could retire later. You could target a higher rate of return. You could reduce your desired general expenses, that sort of thing. And again, if somebody's got a surplus, the suggestions, the options will be different. If somebody's already retired, the options will be different from those for somebody who's in their pre-retirement years. You know, no reference, for instance, to career income. So again, this is an optional thing you can do, but the idea is you do an import, you go to the report, you produce a retirement assessment, you know, print it as a PDF file, and immediately you can ship it back to clients so that they get some sense of whether they're on track or not, or if not, just how far off track they are. And then there are some things, some seeds you're planting about things that they can think about. As I think most of you know, we suggest never changing the initial entries that come in. But instead, in the software, you can create unlimited what-if scenarios. We call them solutions. You can solve a problem in any number of ways. So all you're going to do is create a copy of the initial assessment, give it a name, your retirement plan, and then it's in the copy that you would go in and start making changes. And those changes could be anything. They could be downsizing a house. They could be changing portfolio returns. They could be adjusting the retirement expenses, virtually anything at all. So let's just have a look at a couple of the things that you can do. If I go to the retirement tab, you can see that you could change the desired retirement age, or ages. So let's say a client says, oh, I want to retire at 60. We see that there's a shortfall, then it's very easy just to change the retirement age. And when you do that, all related changes occur automatically. So what I mean by that is if somebody's a salaried employee, they're contributing to a defined contribution plan at work, if you extend their retirement age from 60 to 62, automatically in the background, those DCP contributions will be extended out for another couple of years. So all that stuff's built in. We could adjust desired general expenses down. If you click the edit button, you could go in and you could say, well, let's just notch them down later in life when we're 80, 75. And this particular year is the year of Bill's life expectancy, so let's notch that down a little bit further. So you can go in and make those sorts of changes. And again, remember that we're changing these general expenses. And again, it's one of the reasons why we talk about separating home and vehicle expenses. Just because we're retired or just because we're 80, it doesn't mean that the cost of running our home or the cost of running our vehicle is going to go down. Property taxes are property taxes. So when everything's in kind of one big bundle, you know, some of these expenses are really fairly large and fairly core, and they will not change in our retirement years. And then clearly what we could go and do is we could go in and we could start now applying different portfolio returns, changing the allocation as we looked at earlier when we saw how VisionWorks integrated into Portfolio Builder. So what I want to do is I want to just minimize this, and I'm going to bring up an actual retirement assessment report. Again, this is our little coastal wealth management company that we've created. I'm just going to scroll through it very briefly. There are a number of sections in the report. They're optional. You choose what you want. So disclaimer that you can edit. Table of contents, again, it flexes depending on the sections that you chose to include. A little introduction. You know, who are the plan parties? Remember, you can add people's photos if you wish, which always makes the plan more friendly. And if I just enlarge this page, you can see that it starts off, with the initial goals, the 85,000, the 65, the 60, and then because the initial assessment report talked in terms of options, what this page does is it talks in terms of the major decisions. So you can see one of the things that I did here is I actually changed the rates of return to get the financial forecast on side. If we scroll down to the next page, you'll see the ability to add other wants. So all you do is you click on it and put in anything else that you want to itemize, like those charitable donations that we talked about. You know, the plan will flex right up to a full cash flow based plan. So if they want to talk about charitable donations, you can, you know, add them in here. This is an optional section. And then to me, this is really the key part of the plan. I'm just going to go down to 50%. What it does is it shows the before and after total net worth. So the initial assessment, what they just sent you, and then ultimately the retirement plan. And you can actually see here that there's not much of a change in their net worth. If I go down to the next page, though, this presents a forecast of their income assets. So again, open money, TFSAs, RSPs. And you can see initially there was that big shortfall, but after some changes, they're now on side. And quite literally, what I've done is I've just gone in and itemized the major changes. They're going to downsize their house at 875 and 70. They're going to reduce their expenses, that 50, 40, 30 reduction that I showed you. They're going to cut back to one vehicle when they're 70 and 65. They don't think they'll need two vehicles. And then there was an adjustment that I made to the rates of return. So just a few of the key major changes, and then what it immediately shows clients is what the impact is on, you know, their retirement forecast. If we keep going down, some of the other things that are in here are to-dos in the sense of contributions and savings over the next 2 years. If we keep going down, we'll see here, let me just expand that a little. It's kind of like a mini budget. These are their career incomes over the next 5 years. And then the different home lifestyle expenses, again, TFSA, RSP contributions, target values for different assets. And then if we keep going down, an optional net worth statement, this is your starting point. And then going down further, there are some planning tactics that you can choose to include or not include, different tax tactics, including donation tactics, etc. And then here, start ages for OAS CPP. And then if I go down a little further, an investment policy section, risk tolerance ages, these were off the questionnaire. And then what I want you to notice with the portfolios is that what this is actually doing is it's providing the total of all of Bill's portfolios, open, TFSA, and RRSP. And I'm going to come back and speak about this in a minute. So it's not itemizing individual portfolios, it's just providing the totals, including the ability to do a Monte Carlo for all portfolios in the plan. You can see the same thing for Sue, total value of all her portfolios. And then if we go down a little further, retirement sources and uses. So a stacked bar graph, this is the sale of their home, by the way, when they downsize to a condominium. So it's a big spike up. But otherwise, government benefits, TFSAs, career income initially until they retire. And then we express that both in inflated and constant or today's dollars. Then a table that just summarizes some of the numbers. You'll notice it starts in 2025 when they retire. It's the first 5 years and then every 5 years after that. So our choice was not to provide pages and pages and pages of spreadsheet numbers. If you want to attach pages of spreadsheet numbers as an appendix, by all means in the plan you can produce output to a spreadsheet and then give great detail if you want to. So I'll just go down quickly through this income assets forecast again in inflated dollars, today's dollars, a little table, same idea, and then finally just a brief appendix, some assumptions about real estate growth rates and so on. So that's what a retirement assessment plan looks like, generally speaking. Now, I just want to cycle back to that comment I made about portfolios. One of the observations that I'll make is that most planning software is very heavily focused on portfolio returns. But in real life, there are many ways of getting from where you are to where you want to be. Downsizing a house is an example that I used here that made a significant difference to them. Cutting back how often you buy cars and how much you spend for them. Things that are lifestyle and decisions that are under people's direct control. So when it comes to the IPS, you might do something as simple as the risk tolerance gauge and then the total of all portfolios within the retirement plan. What you can then do, and the video on retirement assessment plan shows you how to do this, is you can clear everything off, select the cover page, go down, and just include the IPS sections, including the individual portfolios, and then produce a separate IPS report. And just to show you how that looks, I put one together. So I just called it investment policy statement. And as we scroll down and have a look at it, this would be an introduction section that you could edit, add anything you want, the risk gauge. And now in this case, what we're going to do is we're going to present outputs for individual portfolios. So before, total in the plan, now in the IPS, Bill's non-registered portfolio, whatever changes we're looking at in it, going down, and you can see there's some sectors here, going down, then is TFSA, then is RSP, with the same content. So this plan runs out to quite a few pages. If you include all that detail in the plan proper, then it's going to get very portfolio heavy. So we talk in terms of, or suggest that the retirement plan just use the total, so it keeps some perspective, some balance. It's not all about portfolios, and then very easily create a separate IPS. Any questions or comments? Sorry, we've got some background noise. Any questions or comments that anybody has? Should I start asking specific people?
I think we just move on, Michael.
Okay. One last thing that I just want to show you is you may start off with a retirement or retirement and estate assessment plan for a client, even an A and B client. So remember, people's perceptions about planning often are not very favorable. I have this wonderful cartoon, somebody standing in front of a storefront, and the sign above the store says financial planning, and on either side the stores are rock and hard place. And then the caption above the person's head is just as I suspected. So the idea of financial planning, you're going to give me long questionnaires, multiple meetings, you're going to give me some massive report with all sorts of asset allocation theory that I don't understand, pages of spreadsheet numbers, et cetera, et cetera, et cetera. I really don't want to go there. I'd rather play golf. Just let me know if I'll be okay. So you can certainly have A and B clients who have that attitude. And you can start with a retirement or retirement and estate assessment plan. But what you're able to do once you've completed it and maybe expose clients to some of the other things that they can look into, more lifestyle-based, et cetera, all you need to do is click the edit button, and then you can immediately promote the plan from a retirement assessment to a full financial plan, literally just by clicking the button and making the change. So there's lots of flexibility around this. Similarly, if you've got the data for a retirement assessment from a retirement assessment questionnaire, and you open the financial planning questionnaire, what you're actually able to do is do a load and load all the known data from the retirement assessment questionnaire into the financial planning questionnaire, which is clearly somewhat more extensive around lifestyle expenses. So we've built in a lot of this sort of functionality around really flexibility so that you can start doing something that's relatively easy, expand on that as clients become more familiar with what they're capable of doing, or as you, for instance, become more familiar with the software. So let's just go back very briefly to the menu. We talked about Portfolio Builder. We build portfolios or at least add specific holdings in one place, and then they're available to be imported into open portfolios, TFSAs, RSPs, the Smith's plan, the Jones plan. We talked about the two types of retirement assessments, particularly for C&D clients, and the questionnaires, and how the questionnaires really, when we're talking the retirement assessment type plans, make creating those plans very efficient. One of the other things that I just want to point out is that with that July release, one of the things we did was we completely revised all the training videos. So if you've been exposed to the videos before last July, what you're going to find is that the quality now is significantly better. The videos that we had were several years old. The sound quality was not very good. They used an older technology. The playing time was about 5.5 hours. We cut the playing time down to, actually, if you add it all up, including how to produce a report, we've cut it all down to about 4 hours. And just to show you how these work, if we run this, what you'll see is that in consolidating the videos and cutting down the time, we actually combined a number of videos and increased not just the quality, but also added a lot of what I'm going to call tips and techniques. So I'm just going to fast forward a little bit to show you some of this. Let me go forward here. So now you're being directed to click this tab, you're being directed to open this list, and so on. So these are way better quality. So if you haven't revisited the videos since the July release, I strongly suggest that you go back and have a look at them. I think you'll find them to be much, much better. Any final questions that anybody might have? Or Jeremy, any comments you want to make?
Not really. I think just one other thing regarding Portfolio Builder, you know, as an individual planner, you're structuring portfolios that you use. That's fantastic. It works great. Any change you make to, say, a future return for a mutual fund or any other equity asset or whatever it is, you make that change once there, that carries through to all clients. So you're not having to adjust, you know, every client's file with something that you've decided to make an adjustment to. Additionally, you know, similar to the templates that are built in the software for reports or the look and feel files, the portfolios once built are also transferable amongst coworkers or other people that are, you know, doing work for you. So it only has to happen once, and then you can have that data exchange between everybody who works in the office.
The one last thing that I just want to show you, you may recall a couple of times I made a change in Portfolio Builder, but then that wasn't available when I was actually demonstrating VisionWorks. And when I tried to do the attachment of the PDF file that the client completed to an email, it didn't work. And the reason is what you're looking at right now is actually my desktop with VisionWorks on it. But what I've been doing to demonstrate the software is I've actually been using a remote desktop. So this is, if you will, in the cloud, and it's something that we're working on. All the demonstrating I did with VisionWorks today, the retirement assessment plans, the full financial plan, whatever, was all done in this, and all the PDF files I brought up is all done in this remote desktop environment. So it's got a lot of advantages. You can operate the remote desktop virtually from any device. You've got access anywhere you want. Your assistant can log in and do work in this environment. No need to transfer files back and forth and so on. So this is our new initiative, and as you can see, it's coming along very well. There are just a few things that email client, for instance, but most things are actually operating quite efficiently right now. So any final questions that anyone has?
One more question from Blair here, going back to Portfolio Builder. You indicated we could insert the mutual fund codes and the historical rates of return come up and so forth.
Yeah.
So how current are those, and are they regularly updated, or do we?
Good question. The updates are part of a regular VisionWorks release, and right now we update those returns on a quarterly basis. So we get a new fund data file every quarter. So if you're looking at longer term returns, 10 years or whatever, the change in return, even if it's dramatic on a quarter by quarter basis, really won't affect the long-term returns that much. The real reason that we update quarterly, or the main reason, is because, of course, the fund companies are constantly issuing new funds. So we want to make sure when you type in a fund code that the returns for that fund are populated.
So if I'm looking at a particular fund and the rates of return there, that would be probably the quarter prior to the last release data that you downloaded from the mutual fund company? Okay, thanks.
Yeah.
And a quick comment on that: if you've added and changed and put in, say, a selection of mutual funds, well, we're not going to go and enforce a change, because you may have already, as Michael indicated, if you've got a fund that's got a shorter track record and has a 15% NAV, you may have made an adjustment there, right, to say, look, that's unrealistic for the next 50 years. So if you've done and made these adjustments, we're not going to go and kind of trump what you've changed. So, but if you were to maybe remove that mutual fund and re-add the same one again, you're going to get the updated data for the future, right? So again, it's all about the flexibility. If I think what's going to happen exactly as Michael's showing here, you're going to make an adjustment to that because 50 year into the future, your 15% year over year seems a bit rich. So.
Oh, you've confused me again now. So you've made that one change, and I update my software with your next release. So you've just said that NAV won't change. Will the other rates change? Update?
Well, again, if you've made, it's an issue of if you were to build you're selecting a particular fund here with the data that's in the database. You can add your own and make it up. It could be the XYZ ABC. So whatever you've got in there is your library. So if you've made adjustments to this and customized it in some way, we're not going to come back and say, well, now we're going to spit back in that 15.07%, right? If I was to remove that fund, right, or add it, in, the new default data will come through, right? So as we're updating quarterly, if you want to refresh based on defaults, then you can just re-add the fund and get the new information.
Will the fund, if I have made no changes to the imported amounts, do I still need to delete and re-enter to get the update, or does your software determine, Blair changed that edge point 1801, so we're not going to touch it? If I did not change it, is it going to update automatically? Follow what I'm trying to say?
Right. So you're saying, will it just automatically adjust the rates of return into the future? Well, no, it won't, because you've added it as part of your library, right? So if we were to go in and make these adjustments on a quarterly basis, if you've done a bunch of work around what, even if it was just the default settings, you may have done a lot of planning work for that client with these assumed returns and made all kinds of changes to future expenses, et cetera, et cetera, et cetera. So if you've written up commentary, presented our plan, and we went in and just updated numbers every quarter. I mean, like Michael said, if it's 15.07, if we're looking at 10-year numbers, it's obviously not going to change a whole lot necessarily, but that would then force an adjustment to whatever you've maybe written up as far as a commentary, and then force an adjustment in your report, basically. So
agreed. Sorry. I guess that all makes sense, and I hope it would be the way it works. I guess I was thinking if I had a model portfolio and that I use for all clients, and then imported it into a particular client, whether the model portfolio would update or not.
Well, again, you can manually adjust this as well, right? So if you did want to make an adjustment, you've imported the EDG 1801. If on a quarterly basis, you can make an adjustment to it, and as I mentioned before, that will flow through to all of your clients, right? So if you adjust this in any way as part of your library, that change will carry through, right? So it's just not going to automatically update.
Yeah, let's just say, Blair, that I created a balanced portfolio and I had the edge point fund in it. And then what I did, for whatever reason, is I decided, no, I don't want that. I want the McKinsey fund. Right. So what I'm going to do now is I'm going to delete the edge point fund, and I'm going to add the McKinsey fund. And if I have used this balanced portfolio, what's going to happen is when I open up VisionWorks, the balanced portfolio VisionWorks is going to refer to the balanced portfolio in Portfolio Builder, and it will know that it is now the McKinsey fund that's being used in the McKinsey returns. So if you've got several funds in your balanced portfolio and you elect to replace one of them, then VisionWorks is going to update and reflect the effect of replacing that fund.
Gotcha. Thank you.
Okay.
Mike, it's Elfeth here. I just have one question for you.
Yes, sir. Yeah.
When we're doing Monte Carlo analysis, can we use a Gaussian wave model with outliers on both sides to be able to determine what the Monte Carlo would give us as far as the investment returns?
I have absolutely no idea what you're talking about.
I'm sorry, like using a bell curve on the outputs for the Monte Carlo to determine what the frequency of the rates of return would be as far as the amount of income that would come out of the portfolio, using the appropriate standard deviation model.
Jeremy, do you have any idea what I was speaking of?
What we do
All right.
offer, we're just going to be showing you, like, if Michael, I think the best place to look is just in the report that you've got up there. We do have, it's not going to list then specifically the income in dollars that are flowing off, but when you look at, can you bring that up, Michael?
And I haven't looked at it, so I apologize.
Yeah, no, that's fine. That's what I'm trying to get at. When we look at the Monte Carlo analysis, so if you can zoom in there, Michael, just it doesn't matter which one.
Yeah, just should I go down to total?
Pick one of them. Just there, that's good.
Okay.
So what we do present is a probability of success, and
Yeah.
then you have your range, up and down.
Oh, okay.
So you've got your 90th, your 10th, and your
value.
median.
Oh, okay. Yeah, I see what you're saying here. Okay.
Yeah.
I haven't done it, so that's why I was just wondering if it was more of a bell curve type of approach or Gaussian model versus, just looking at the dollar value, more or less looking for, what probability is the income going to be there from the cash flow perspective, right? So that's where I was going on that question.
Right. So I don't think we don't dive super deep into it, but we do obviously just provide the 90th, 10th, and median.
Okay, and that's
percentiles.
cool. I mean, it's speculative in most cases anyway.
Yeah, well, that's the thing, and you haven't looked at it, but that's understandable. When you do, there is significant calculation that takes place, and then as you're indicating, the issue is the minute you run it again, you're going to get different results, right? Because it's all obviously randomized. So
yeah, absolutely.
we all take these things with a bit of a grain of salt, right? So,
Sure. Okay. Great.
Okay.
Thanks, Jeremy.
Anybody else with any questions? So if not, I want to thank you for your time today, and if anything does come up, please let us know.
Actually, Michael, before you close that off, can you cancel that?
Oh, yeah.
I just wanted to point out to everybody again, I think we went through it pretty quickly in terms of this remote desktop offering. It is something we're just in the final stages of preparing to have made available for people. What we've heard a lot of over the years, and the software works fantastically on your own systems generally. The issue is moving from laptop to desktop at the office to, wherever. It requires a lot of backing up of files, file transfers, etc. But what this is going to do is provide you with a clean environment that's running simply just the software. It's going to have some enhancements in terms of processing power to get the job done more quickly. But it will be, as Michael said, available anywhere you're going to have access to the internet. So you will even be able to access this on an iPad. You'll be able to access the software on your phone, and if you're so technically capable, you can project from your phone to a client's smart television. I just see it's going to be a great, great thing. It's going to solve a lot of the issues we've been having with, moving files around as well. So just something that's coming up. We think, there will be an added cost in some cases, but I think just the benefit is just going to be amazing to really push the software forward. All right.
Okay. Thank you again for your time, and Happy New Year.
Happy New Year to you too.
Thanks.
Right. Bye-bye.